Okay, let's go ahead and go through that two-year translation example solution. And again, just to remind ourselves, we had the following information. Assume that Big acquired 70% of Little's voting stock on January 1st, 16 for 350,000 Swiss francs. On that date, the exchange rate was $1.05 per Swiss franc. The fair value of the non-controlling interest was proportional at 150,000 Swiss francs. And on that day, Little had owner's equity of 500,000 Swiss francs, and all assets had book values equal to fair values. And we've got 2 years worth of data on trial balances and exchange rates. And basically for each year, we're going to want to translate the trial balance into US dollars, prepare all appropriate equity method entries, and prepare all appropriate elimination entries. So here's our Swiss franc denominated trial balance, and of course the trial balance balances. And we've got an assortment of exchange rates. And again, the first step is going to be to apply the appropriate exchange rate to the different financial statement elements. Under translation, all assets and liabilities are translated at the end of year or current exchange rate. So all of those Swiss franc numbers multiplied by 1.11, the 1231 exchange rate. The paid-in capital account, common stock, is going to be translated at the historic rate from the date of acquisition. Retained earnings, as indicated earlier, retained earnings will be translated the first year at the date of acquisition exchange rate. Subsequent years, that retained earnings figure will be carried forward from the previous year's worksheet. Revenues and expenses at the average rate of $1.10. And finally, dividends at the rate on the dividend date, so $1.08 per Swiss franc. We add up all of our total debits, so we have $1,603,200 in debits. Total credits, $1,573,500. And so to make this thing balance, we need a credit of $29,700. And again, note the pattern of the exchange rates. The exchange rate went from $1.05 at the beginning of the year to $1.11 at the end of the year, so the Swiss franc has appreciated, which means that our investment, measured in Swiss francs, has appreciated as well, just by virtue of the increase in the exchange rate. So we'll go ahead and put that other comprehensive income translation gain on the income statement, or on the trial balance. Little's income measured in dollars is $132,000, again basically sales of $660, less operating expenses of $528,000. Since Big owns 70% of Little, that means that their investment income will be $92,400, 70% of $132,000. So let's go ahead and go ahead and run through our equity method entries. Income, again 70% of Little's reported income. Dividends, again $54,000 cash equivalent in dividends. Big received 70% of that. And now the new one, Big reports their share of the other comprehensive income. Recall that Little had a $29,700 translation gain, so Big reports their share of that, or $20,790. For our elimination entries, as always, we're going to go ahead and eliminate the subsidiaries' beginning of year equity accounts. And that total of $525,000 is going to be split 70-30 between the investment and the non-controlling interest. A for amortization, not applicable. I for investment income. And let's go ahead and do this in two parts. Again, we need to eliminate the investment income that Big reported, and they showed income from their investment in two ways. They had their share of Little's reported earnings, which we're going to eliminate, and that's the same as it's always been. But we also need to eliminate that translation gain that Big reported. And that second I entry is essentially reversing the equity method entry when we recorded Big's share of the other comprehensive income. D for dividends, nothing new there. As always, we eliminate the subsidiaries' dividends declared, split that 70-30 between the investment and the non-controlling interest. And then finally we have our income to the non-controlling shareholders, again in two parts. We're going to allocate 30% of the reported earnings to the non-controlling interest, And we're also going to allocate 30% of the other comprehensive income to the non-controlling interest. Okay, so we carry this stuff forward to the year 2 translation problem, and notice that in the trial balance there, at the very bottom, we have the accumulated other comprehensive income, translation gain or loss. That translation gain or loss didn't exist on Little's Swiss franc denominated trial balance. It didn't exist in their Swiss franc denominated income statement. It did, however, exist in the dollar-denominated income statement, which means that it gets carried forward as dollar-denominated accumulated other comprehensive income. Okay, so again, let's go ahead and apply the appropriate exchange rates to all the various items. The Swiss franc has fallen in value by more than 10%. It's down to 90 cents per Swiss franc. And so again, we multiply all of the assets and liabilities by that end-of-year exchange ratio. And again, just sort of anticipating what we expect to see, the Swiss franc has fallen rather substantially in value, so the value of our investment is going to fall because the Swiss franc has fallen. So we should expect to see another comprehensive income translation loss this year because, again, the value of our investment is falling. Common stock, again, is going to be converted at the historic rate from the date of acquisition. Retained earnings we carry forward from last year's worksheet. Now recall that last year our beginning retained earnings was $315,000. We add the dollar income of $132,000, deduct the dollar dividends of $54,000, and so last year's ending retained earnings for Little, measured in dollars, was $393,000. And that's the amount we carry forward as beginning retained earnings for year 2. Sales and operating expenses at the average rate again, and dividends again at the exchange rate for the dividends. Okay, again, just as a note, Little's dollar-denominated income this year is $140,000, $650,000 in sales, less $510,000 in operating expenses. Big's share of that, 70%, will be $98,000. So we go ahead and add up all of our debits, $1,417,800 in debits. Add up all of our dollar value credits, $1,543,700. And so to get this thing to balance, we need a sizable debit of $125,900. And so that will be a translation loss this year. So let's go ahead and go through our year 2 equity method entries. Again, we're going to report investment income, 70% of the $140,000 of reported earnings. Dividends, we receive our share of the $61,800 in cash dividends. And our share of the translation loss. Again, we had a rather sizable translation loss this year. Big company reports their share, 70% of that translation loss. Now we go through to our year 2 elimination interest, and here's where we have something new. As always, we're going to go ahead and eliminate the subsidiaries' beginning of year owner's equity accounts, but among their owner's equity accounts is the accumulated other comprehensive income. And again, on their trial balance, they had a $29,700 credit balance in accumulated other comprehensive income. That is an equity account that needs to be eliminated along with all of their other equity accounts. So we add up all those debits, they total up to $632,700, And we're going to split that, as always, 70-30 between the investment in little and the non-controlling interest. A for amortization, not applicable again. I for investment income. And let's go ahead and handle the other comprehensive income aspect of this in the manner that the Christensen text does. Again, as I've said repeatedly, we can organize these elimination entries in any of a number of different ways. I have a certain way I like to do it. The textbook authors have a way that they like to do it. You can do it whichever way you darn well please. So anyway, I for investment income, as always, we go ahead and eliminate our investment income against the investment in little. D for dividends, as always. And Inc., as always. Again, allocating 30% of little's reported earnings. Now we have this other comprehensive income entry. Again, this is the way the textbook likes to prepare it. Basically, they're going to take what we previously viewed as the second half of the I entry and the second half of the Inc. entries and combine them into a single entry. So again, we're going to go ahead and eliminate Big's translation loss, and we eliminate that against their investment in little. We're also going to go ahead and allocate part of that translation loss to the non-controlling interest. So again, we're going to take away, if you sort of visualize what's going on in the statement of comprehensive income, we've got this $120,000 debit balance, this translation loss for this year, and we're going to go ahead and take away part of that with a credit and essentially allocate that to the non-controlling interest. Okay, let's go ahead and see how the translation gain or loss and the accumulated other comprehensive income would be worked into our worksheet. Now, and again, instead of doing the entire worksheet, let's just focus solely on the aspects of the worksheet related to the other comprehensive income. So here's our 6-column worksheet, and the two things that we're going to be adding to our worksheet. First, we have our statement of other comprehensive income. Now again, if you were to look at a random company's 10K and you were to look at their income statement, they would report their sort of regular income statement, sales minus expenses, all that good stuff. And then immediately after reporting net income, they would do their statement of other comprehensive income. So they would add other comprehensive income less the other comprehensive income to the non-controlling interest, equaling the income to the controlling interest, or the other comprehensive income to the controlling interest. Similarly, just as we have the statement of retained earnings, which is essentially the statement of accumulated earnings, we also have a statement of accumulated other comprehensive income. And it has the same basic structure as the statement of retained earnings without the dividend aspect. So we're going to have beginning accumulated other comprehensive income. We add this year's other comprehensive income to get ending accumulated other comprehensive income. How you incorporate these 6 additional lines into your worksheet is up to you. Again, when you do this in the problems from the textbook or do them in exercises, often the person who creates the assignment sort of takes it upon themselves to organize the worksheet for you. Again, the Christensen text takes those last 3 lines and puts them down at the very, very bottom of the worksheet after the owner's equity section. Okay, so what do we have in our worksheet? Little has beginning accumulated other comprehensive income of $29,700, and again, it's important to note that that's a credit balance. The other comprehensive income and the accumulated other comprehensive income can be either debits or credits. And Big has beginning accumulated other comprehensive income equal to their share of that $29,700. We also have other comprehensive income for this year. Again, that plug figure on Little's trial balance was $125,900 as a debit balance, and Big reported their 70% of that, or $88,130. In terms of our elimination entries, again, in the S entry, we eliminated the beginning of year accumulated other comprehensive income. And again, looking under the Little column, we had a $29,700 credit balance So to eliminate that, we debited it, so we have that entry in the debit column. In the OCI entry, we did two things. We took away the parent's other comprehensive income, and again, the other comprehensive income is a debit in this case, so we're going to credit it to get rid of it. And we also credited $37,700 to the other comprehensive income to the non-controlling interest. Okay, just to refresh our memories on how these things tie together. And again, this is perfectly analogous to what happens with the regular income and the statement of retained earnings. We take our other comprehensive income for the period and transfer it down to our statement of accumulated other comprehensive income. And then we get our ending accumulated other comprehensive income by working our way down. So for big, $20,709 credit balance, offset by an $88,130 debit balance, leaves us with a net $67,340 debit. Okay, so let's go ahead and add across to get the consolidated totals. Again, other comprehensive income, we've eliminated the parent's or big's other comprehensive income, so we're left with little's, which represents the total translation gain or loss. There's a $125,900 translation loss this year, of which we allocated $37,700 to the non-controlling shareholders. And again, the counterpart to that $37,770 credit is going to be a $37,770 debit to the non-controlling interest. And so we're left with $88,130 being the other comprehensive income to the controlling interests. And again, that gets transferred down to the statement of accumulated other comprehensive income. Continuing on, we eliminate the subsidiaries AOCI, because again, basically what we want for the AOCI, we want this viewed from the parent's perspective. So we have the parent's beginning AOCI plus the parent's other comprehensive income equaling the parent's ending accumulated other comprehensive income.